Crude oil prices are collapsing, and we may say terms like that frequently, but not for the types of things that we've seen like this. WTI this morning down more than 35%, not for week to date, not for month to date, not for year to date. This is for this morning. WTI for that May delivery down 36% to $11.67. Let's bring in an analyst on the phone this morning. Doug Terreson is the head of energy research at Evercore ISI. Doug, what's happening here?
So good morning, Becky. So our report today was called a dog's breakfast. That's a phrase for something that's extremely messy, which obviously the oil market is today as we reach 20-year lows. And the reason for the weakness is related to a couple of factors. First, expectations for oil demand and GDP are falling in an unprecedented way and by around 10 times that which we normally see in a recession. And so while the equity market is suggesting that we're going to have a coronavirus solution in coming quarters and that demand will recover, and we all hope that is the case, the problem is that in the near term, meaning the second quarter of 2020, supply is going to be over demand by around 15 million barrels per day or so, which when combined with the 7 million barrel build in the first quarter, puts us in a scenario whereby we're probably not going to have enough storage to accommodate this supply. So in this scenario, prices for crude oil are going to remain very weak. They're going to be near variable production costs for marginal producers, which supports our call for Brent 25 in the second quarter. But WTI, as you referred to a minute ago, is probably going to be 70 to 80% of that amount. If global economic growth recovers beyond that point, and OPEC and other supply cuts hold, then we're going to see inventories decline from record levels of 90 days at the middle of this year to maybe 60 days at the end of 2020 and 50 at the end of 2021. But this is high in relation to 40 years historically. But we could have a recovery to Brent 40 by the end of this year, but we have to have some help from the demand side.
Hey, we should just point out, Doug, that this decline that is so sharp today for May WTI is because the May contract expires tomorrow. So people have to take delivery of this. They've got to find somewhere to store it. The ships that store this stuff are virtually full. Storage tanks in the United States are virtually full. So that's why you see this May contract in particular under so much pressure. But the June contract is down 10% too. It's trading at around $22. What do you think a fair price is for June and then July delivery?
So Becky, you're right. I think your point is that this looks really bad on the screen, but it's worse in the physical market. You're absolutely right that crude oil today in the spot market in Alaska, in Canada, Bakken, Permian, $10 to $15 per barrel. We think that until we see additional supply cuts materialize, we're probably going to be around 25 Brent, and like we said, maybe 78% of that number for WTI during the next couple of months.